Good to go. Right, welcome members. I say that advisedly. Welcome members to this Finance and Services Committee meeting, which may be the last meeting of the triennium. We're not absolutely sure on that, but it's looking that way, depending on how we go with our meeting today. So in the room, we have Stu Kneebone, and we have online, we don't have anybody online as yet. Hello, look at that. Why did I predict that? Andrew has just joined us. So in the room, we now have Andrew McPherson. Welcome, Andrew. Ready to settle? We've only just started. So we have apologies tendered from Hugh Verco for lateness, but he'll join us online a little later. And we also have an apology from and Councillor Stu Husband for apologies because he is unable to attend the meeting. So we have those two apologies. So I will move those apologies be accepted. Seconded by Councillor Kneebone. All those in favour, please say aye. Aye. Those against, carried. We now move on to confirmation of the agenda, which we have quite a full agenda today. And I'll take it, Stu, will you move the confirmation of the agenda? And I'll second. All those in favour, please say aye. Aye. Those against, carried. Any disclosures of interest? And I'll just check with Andrew when he returns as well. Any further disclosures of interest, particularly related to any items on the agenda? There being none, and I'll raise that point again once Andrew comes in. So with that, we will now move to item 4, which is on page 6, which is the matters arising from previous minutes. Janine.
Thank you, Mr. Chair, and good morning, committee members. As noted, only those 2 matters from previous committee meetings, one with respect to the value of sand royalties being received by council. Just noting that requests for information from Winstones around audit certificates and extracted volumes are still not received, and so staff continue to request that information to just be able to join the ends.
Can I ask that the staff just check what the standard royalties are so it informs their decision as to what that might be in terms of any recommendation to us?
Thank you, Mr. Chair. I will
Thank
note
you.
that.
Do you get the vibes they've been a little bit reluctant, or is it just general admin sort of hiccup, hold-ups?
I know that the requests for the information have been in for some time, and there has been a number of points of follow-up by staff.
Right.
So whether, I couldn't comment on whether that's administration or any broader issue in terms of that relationship.
Okay. Yeah. So, by requesting what I've requested, it will help inform us as to make a decision along with any other comments that they wish to make.
Yeah. I don't imagine there would be a lot of other comparable extractions going on around the north country that would give you some comparable royalty rates. But
I'm familiar with royalty rates on sand, and I've been involved with that and even been effectively an owner where we had those royalties and it was so much per cube. So basically we'll wait to see what comes back, but I'm seeking to have that information in that report that comes back as to what that is, because anybody who has ownership of sand always applies a royalty in the marketplace.
Yeah.
So it's, there's different ways of evidencing that, because some have a machine that takes a photograph of every truck that goes out. Others are actually just scoped on a, you know, where they have to fill out a log. So there's information that we need back to make an informed decision. Janine.
Thank you, Mr. Chair. And then the second point was really just the note that staff had made to previous committee meetings around the uptake and efficacy of the hardship remission. That was an initiative put in by Council as part of our COVID-19 response. It's covered off further in the agenda under our rates reporting and rates collection reporting, just noting really minimal uptake over the last year, looking for some process changes that we're working more actively with the territorial authorities around if they're seeing applications for DIA rebates. They're also getting, ratepayers are also receiving information on our rebate. I be for us to report back to the new council through the 23-24 annual plan setting process around if we've tried a few different things, how are we getting more success in that area? What provision do we need to make in budgets moving forward for it? Or is it something that in terms of a policy setting that we review through the next long-term plan?
Thank you.
Excuse me, Chair.
Janine.
In relation to that matter, it's the market pull signals for that. How do we know there's a demand?
Well, I think what we're seeing now is that there isn't a demand for it, but what we're trying to do is align our processes more closely with the territorial authority process by which ratepayers apply for the DIA rebate. So that's the eligibility criteria for us. And if we can match those two things up and we're still not getting an increase in applications for our rebate, I think that would be clear evidence that the rebate isn't hitting the mark for ratepayers in its current form. And that may be around the value that's actually available to them, which is sort of $35 to offset a year's worth of rates.
I put it to you, Chair, that that's a waste of our time.
Okay.
There's such clear signals that this is not going to work. Why would we continue to bother?
There's one other measure which comes later in the meeting, which is the amount of rates which are unpaid.
Unpaid, yeah.
So the question I have is there relativity between those two items? And so when we come back with further information, we may be able to glean some information by the type of property that is not paying their rates.
I think that metric is clear.
So the question is, if there's information about that, then, you know, it's appropriate to review. But if it's not hitting the right sector, then it's another issue.
If I could make a couple of points. So the property value and location does not speak to the ability of the owner of that property to pay those rates. So there isn't actually a correlation there, which is part of the challenge and part of the concern when we put the rebate in of council staff being in a position to actually assess a ratepayer's financial position and whether they could afford to pay rates or not. That's not a position that I want to be in personally, and it's not a position I want our staff to be in. So that's where it was hooked to the DIA rebate.
We're wasting our time. You've got bigger things to do, better things to do than this.
Yeah, so I guess at the moment we have a provision in our budget this year for $400,000 for that rebate, which is not being directed in the way that was anticipated when we were in the throes and the thick of COVID-19 concerns around economic pressures.
Not social scientists. We're certainly not social engineers.
Right. With that, we can move on to the next item, which is
We need to move on a second.
mover and second for those minutes to be received. Yes. Move. you want a second, Andrew? Yeah. Second, Andrew. All those in favour, please say aye. Aye. Those against, carried. If I'm getting this right, Andrew or Neville online, Ara Tupu, which is the corporate plan, the new name for the corporate plan. Am I right, Neville?
Yes, you're correct there, Chair Barry. And apologies, I can't be with you today. Unfortunately, not feeling the best right now. So I'm joining you online and hopefully I'm coming through clear and not freezing up. So the report I'll take as read. It covers 3 key topics, as you'll see under the purpose statement. Do a quick reflection, if we can, on the 12-month period ending June 30 in respect to the dashboard outcomes. And we'll talk a little bit about the changes that we've got to the dashboard, which will be implemented over the next few months, and a quick overview of the customer experience transformation program that is underway that will have, in our view, a significant impact on the way our customers interact with us. And happy to take questions along the way. So if we just drop down to just below section 9 there, you'll see the dashboard. I do have a presentation of these slides or this information on it if it's worth sharing that. I'm not sure whether you're comfortable with what the information that's been presented in the report. Just yell out if you'd like to see those, see this in a larger format on your screens.
Yep, I can stop sharing my my screen right now, so you can start sharing yours if you'd prefer.
Okay, well, I'll put it up and we'll see. I'm not particularly good at this thing, so we'll just see how we go here. I've got the right document. Oh no, maybe I'm not sharing it properly. I can't. It makes it difficult for me to see, unfortunately. So I'm not sure.
That's coming through, Neville. We can see.
Yeah, we can see that. Yep.
And I'm not sure if I shared the report, to be honest, or the presentation. So I'll take it. It's the presentation that I'm sharing. So if we're looking at the right one, we'll go to that one. Hopefully that's your dashboard slide. Tell me if it's not.
Yes, we can see the dashboard slide.
Okay, so as I said before, this is till the 30th of June of this year. It's for the full year. And these measures, as you'll have seen in the report, have been reviewed and updated. So this is a looking backwards sort of an experience. In the culture area, out of the 8 measures that we look at, and our target range being 6 out of 8, 5 we're on track and 3 we are monitoring. We'll look at those in a little bit more detail in a second. In terms of the customer measures, we have a target range of 3 out of 4 of the measures being on track. At this stage, only 1 is on track and 2 are in a monitoring phase. Again, we'll talk about, and 1 being off track, so we'll talk about that, what our response is to that. No measures still being reported under the excellence goal, and innovation, only 1 of the 4 measures reporting as being on track. So that's that high level view. And I'm going to click on another slide now, so you'll have to tell me if that one's changed. If not, then I've got the wrong slide being shared. So this is the customer view, if that's showing up correctly.
We've got that. Yep.
Cool. And the one that's, when we talked about there being 3 under monitoring, those are the Net Promoter Score that has fallen short of our target goal, resulting in a 45.6 rating overall. Our effort score is off track significantly, in my view, at only 38, which shows that it's hard for customers to engage with us in the way that they want to. We've luckily been able to reduce our abandonment rate, so that's showing a positive level. However, the time for us to respond to IRIS requests is poor in respect to that 2 business days response rate that we're seeking to achieve. I'll keep moving through these, but so ask questions if you like, but we've got some.
I've got a question.
Yes.
Sure, Andrew.
Do you want that now?
Yeah, sure.
If you wish.
Just an observation I had is that I think, Neville, you made the appropriate comment by saying this is looking back. What I gained a lot of confidence from is you've actually made absolutely clear this is the picture, but the steps that you've put in place, which are much later in the report, do show a sign that you've said, right, we need to address these matters. So with that, Andrew, ask the question.
I think there's some disturbing metrics here. And the one that concerns me the most is NPS. And I've been impacted by this Net Promoter Score over the last quarter. On 2 occasions, I've rung the 0800 number, one during office hours, one on a Sunday afternoon while I was waiting to go take my wife to the pictures. The first one, and the reason I was late to the pictures is because it took 16 minutes for someone to get back to me. And it was frustrating to say the least. And that issue resulted in a staff member ringing me at 9 o'clock at night, and I was prepared to go and take him to the contamination site at 9 o'clock at night to find out he'd just driven past it and was back in Hamilton and didn't really want to turn around and come back. Fair enough, happy about that. So that on the grumpy scale, that was about 2 out of 5. And then the next issue took 9 minutes during a working day, took 9 minutes before someone spoke to me. She didn't know who she was going to put me in touch with by name. She said, I think it's the whatnot department you need to go to. And she put me in through to there, and there was a voicemail. And as a result of that, I got a return call a bit later on. So I stood back and I thought, I've got 100% reasons to be really grumpy with the council. And I know the council. And I chose not to go direct, pick up the cell phone and go and talk to the members of the executive team. I chose to come through the front door. And every so often I sit at the front door and I watch what happens as people interact with this council. When they come in through that front door, they're met by exceptional customer service, in my humble opinion. But when they go to this 0800 number, it's decidedly average. So I'm really quite scared about that NPS. I think that's directionally a real issue for us. You might say 0.4 of a move is 1%, who cares? But I think, Chair, it's sending a signal to us that we have an issue, and it's simple customer service stuff. So I applied my mind to that, and I got to thinking, if I was, and I know you and I earlier on were very keen on these 4, I know that, but I'm starting to wonder whether or not we should park the culture, park the excellence, and zero in on customers and innovation.
I would say, just before Neville, you respond, what I've seen in this whole report from start to finish is you acknowledge the Net Promoter Score is not satisfactory. I have looked further into the report. I would be wanting to really get through the whole report so that we can get a sense of the fact that you've already indicated that you're not happy with the Net Promoter Score, and that you have measures which are going to be, you're going to talk to a little later in the report. So do you want to reply at this point and then go through later?
Look, yes, thank you, Chair Barry, and the comments from Councillor McPherson are right on point. They highlight the core issues, and we understand the reasons why these issues are occurring, and the experience that it leads to for our customers. And we have got deliberate strategies in place to try and address them, and I think they are robust strategies. Primarily, we have a siloed customer service delivery model in which groups within the organisation deliver customer-facing services in isolation of others. If you would prefer, maybe I should jump through this part, the historical, and go to what we're doing to address the siloed model we've traditionally operated under, and also the new measures. Would that be?
I would take, it's a journey through this report, and I thought the report was laid out appropriately. I do have some questions on the way through the report as well. Some of it is when you get down to 16, which I think you're not there yet. So I'll wait till you get there. But take us through this journey, because I think it's important that the committee understands where you're at and where staff are at, and then where you're going to move to and how you're going to move there. So, I'll leave you to carry on.
Okay, look, we'll come back and talk about the customer area, when we talk about what we've changed, and also the customer experience transformation program, which is probably the biggest piece of work to affect the changes that we have identified are required. We'll move on to the culture goal area, which is reported under section 16 of the report. As you'll see in this area, we have got we're currently just jumping back here. We're reporting 1 on track and 2 in the monitor area. Now, while we're saying 1 is it's 5 on track and 3 are monitored. The green tick ones show you that we're doing great in terms of our styles and where we're performing through the most recent survey that's been reported in its entirety to council previously. The 3 that are orange are more around how employees feel about the engagement levels they're having at a organisation level, at a directorate level, and then our achievement constructive style reporting lower than what we would wish it to be. One of the problems we have with the survey method is that it is a bi-yearly or twice yearly, report, twice yearly, every 2 years. We get this assessment undertaken, so it's a really big lag measure. The other components of it are the pulse survey, which are done every 6 months, which we think is a reasonable indication of how our people are feeling. But some of these measures are very long between assessments. So we're going to address some of those in the changes that you'll see later.
I've got a question on this particular chart. If you look down to the bottom one, which is self-actuating constructive style and its meaning there, and I think this is quite, I think a good insight where it says self-actualization behaviour is honesty, integrity and self-confidence. And I would have thought that's quite important. It gets a tick when it achieves 25%. I would have thought that's quite a low level to enjoy a green tick. Can you comment on that?
My understanding is that is against all organisations that have previously been assessed and set the benchmark level. And so in comparison to the class in which we are measuring ourselves, that is regarded as being a high outcome. That organisations that have able to measure and demonstrate how well they're doing in this particular style seem to be more advanced from a culture perspective than most. So that's my understanding of how this assessment works, Chair.
Thank you.
It's a range of performance for each style area based upon thousands and thousands of organisations that form the database.
Understand. Carry on. Stu.
Just a quick one, Neville. Is that one would be quite related to personality type too, would it not?
Potentially. The personalities that people might display might make them less less what would you say? I don't want to say less constructive, but probably less assertive. More withdrawn. They may be more passive in style, and self-actualizing is actually about people feeling confident, feeling as if they can present themselves in the fullest form. And so people who are more passive, who are more reserved, may not necessarily think this is something that they feel comfortable with. So to move people in an organisation towards this type of strength area is significant.
Okay, move on.
Okay. So the innovation goal area, a disappointing result here. The report further on gives us...
Sorry, I just wanted to comment on number 16, which is just below that graph. It's got point 16 is referring to progressing to support improvement in organisational culture. I would have thought, I looked at section 16B and it says a survey, the results of this check-in survey will show, and it's got 4 bullet points. A little, let's say, reticent about bullet point 2, which says, if directors and section managers are satisfied with the progress they are making, I would have thought, particularly around this area, that it's more the directors and the CEO. I'm concerned that the section managers are assessing, if you like, their own performance in terms of the culture. So that was a bit surprising to me, that you're measuring it down at that level in terms of satisfaction. I know you have to measure it in terms of what's happening at that level, but having them satisfied as one of the measures, I thought was a bit off. Can you comment on that?
I can. All staff complete the survey, and any group of 5 or more gets its own report. So 5 or less, they get aggregated up to the next level. So if a team leader has, say, half a dozen, 8 or 9 reports to them, they will get a report of more than 5 complete the survey. And that allows us to have a little bit deeper analysis at that level about how that team are feeling. If that feedback isn't as positive as we would like it to be, the expectation is that directors and managers have had that conversation. They've talked with the section manager, who has talked with the team. And as you'll see under bullet point 3, that they're looking to develop an action plan, understand what additional support might be required to correct the results and the outcome that they're experiencing. So that's really, I guess, wording might be a little bit ambiguous, but really what they're saying is, if there's a problem, let's address it.
So the manager, what you're saying is the process won't allow a section manager to mask maybe the lack of appropriate culture in their particular area?
No, we get visibility as ELT, as the chief executive, has visibility of every group across the organisation where 5 or more staff have responded.
Thank you. Carry on.
Chair,
sorry, Andrew.
I'm picked up on section 16 too. Because specifically to your point, Chair, I read those and I thought these guys, what's the term I'd use, could be really smoking their own dope. You know, well, I'm trying to think of the more elegant way of putting it. They're in their own echo chamber.
Yeah.
So
that's what my point was.
So I'm a 19-year-old university graduate, smart as all hell, and I join a team here of 15 people. The most senior is 64 years old, and there's nothing that he or she hasn't seen. And I'm really struggling. I'm 19, I've got a university degree. I'm probably a little bit wet behind the ears. I really, really believe in this thing that I'm doing. But this culture I'm finding this culture really claustrophobic, and I'm not enjoying it. So my question is, Neville, how do we make sure that which I think is the point where the chair was going as well, how do we make sure that we actually run our stethoscope over the people in this organisation where there's the most risk of poor culture burning them off? And if I could get some comfort that this survey is not everyone standing around slapping each other on the back saying, hooray, aren't we doing a great job? and because I know, Neville, that's not what you want, but I just want to get some satisfaction, Chair, that we are actually getting a look at these new young people coming into the organisation that we want to nurture and give a career to. Do you know what I mean?
I do. Look, those are really, really great questions and really relevant to what we're trying to develop across our employee value proposition. Trying to create this, so we use the statement, a place where people can be their best, and giving life to that is really more challenging. Like, it's a nice, simple statement to roll off the tongue, but actually making that a reality is quite complex. How do you attract good people? How do they have clarity around what their role requires of them? How do they know how they're doing in that role? What support and tools and techniques have they got to support them to develop and feel confident and successful in the role? How do they provide feedback? So there's a whole bunch of elements to that employee value proposition that we are definitely putting a lot of work into. It is a program that has a lot of support from ELT. We want our eyes on it because we see it has a direct correlation to recruitment, attraction and retention. And the young cohort that you're talking about, Councillor McPherson, absolutely, they're different today. They have different experiences and different expectations. And accommodating those is really, really important for us. Understanding what their needs are. So we have other mechanisms as well, I guess, such as the Wellbeing Committee, which is a cross-organisational collection of staff who gather to talk about what are the other support and enabling requirements that our people could benefit from. And we've done a lot of work in that space quite recently, providing a whole range of different mechanisms that staff can access to support them, right across from their exercise to their diet, to their ability to interact with each other, to get online support for a range of different needs and requirements. So it is a broad church in that regard.
Right, thank you. Thank you. Can you move on to the innovation? Well,
so not a great story in this innovation space. We've got a bit of an explanation about why it's so challenging. It's not a true reflection of the innovation going on in the organisation. And
I picked up on that. You don't need to. I've just got a question. I think we all recognise that what the report's saying. I just make this comment that you're saying that recording innovation ideas on Launchpad system is really not cutting the mustard, and that's obviously clear. What I think is very important here is two things. One, how we respond to ideas raised and they're not brushed off, and you have a simple mechanism. And the response has to be positive to anybody who raises and there has to be a reasoned response as well. So why isn't it just able that somebody can easily log, satisfy through an email, an idea and just log it with directors that they can look at their leisure, log it somewhere where essentially you're capturing all that, rather than getting into a system which is very bureaucratic and very time consuming. So simplicity is the answer here, because people will not bring innovation through if they think they're just going to be fobbed off. So we really have to have a simple, responsive system. Comment?
Yes, we haven't identified what that system, that simplified system, should look like, but you're bang on in respect to it should be as simple as an email. Over time, we will be linking this to the Enterprise Portfolio Office, which Janine is responsible for. Within that area, we're developing the project program pipeline, which will give us a really good solid measures over time, just through the identification, implementation, execution of programs and projects, and how they're performing across the life cycle, which will be a far, more objective view of how we're performing in the innovation space, far more robust and solid, with a lot of metrics around not just outcomes, but capacity release and cost savings, etc. So we don't have that established to the degree we wish at the moment. So we will go with something simple in the interim, such as what you've commented on.
Thanks,
Chair
Neville.
Barry.
Andrew has a question, comment?
Oh, well, Chair, with all due respect, I thought Neville, I'd like to hear what Neville was going to say to us before you.
I'll ask the question.
I thought you jumped in a little bit quick with all due
trying to
respect.
move things.
Well, yeah, this is,
I know it's
we shouldn't speak through this.
Yeah.
This is some of the most important work that this council does. And we should show it a huge amount of respect because it's the only way that we as governors get a way to drive change in the corporate behaviour of this organisation. So you're doing God's work, Neville, and I want to, was there anything you were going to say in your introduction that you didn't get a chance to say? Because I have got a question that I want to ask as well.
No, not really, because we'll cover that off a little bit further down when we get to the changes that are being proposed to these metrics. But really, the substantial one is that the EPO, when it is matured to the point that will probably be up to a year away, where our pipeline, our program and project pipeline is really robust and well tested, will demonstrate to us the ideas that come in at the beginning, how they are implemented and executed, and the outcome that they achieve. And at the moment, what we see is a lot of the projects in particular lag or don't necessarily achieve what we expected to in the time that we expected them to, which may be a problem at the ideation end. It may be a problem during execution. I'm not 100% certain at this point, but what we want to do is not implement or execute a project until we're absolutely certain we've got all of the nuts and bolts and the machinery in place to support and enable it to be successful, and that we should have very little surprises at the end of it. In fact, the only surprises we should have should be positive ones, that so we actually achieve more than we expected to here for less.
Well, my question, Neville, is about that, because I've looked really carefully through this organisation for evidence of innovation, and I see it. Everywhere I look, I see a group of people that are trying to do things differently and better. I'll give you an example. 4 months ago, I was I was late for a meeting, and there was a couple of young fellas downstairs loading a robotic vessel into the back of a car. I said, "What are you going to do with that?" "We're going to do some soundings on a lake as this machine goes over the lake." And the young fella there said, "And we're going to try something new." And it was blah, 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 blah. And I thought, good on you, because that wasn't a pale male and stale saying this is the way we've always done it and this is how we're going to do it. It was a smart young man saying, I'm going to try something different. Now, the point is, that's an innovation, but I bet you he did not record that as an innovation. So the point I want to make, Chair, is I'm wondering here, if it's not reluctance of the staff, it's that they may not know what and how to report. What they may be doing every day of the week, like the little card, is a classic example of innovation, driving waste out and continuous improvement. So I don't think this council should beat itself up on this, but I do think we should help you, Neville, to really tease this apart, because I think you're right, Neville. We're going to give ourselves a fail when, in fact, we're absolutely due to pat ourselves on the back about innovation.
Yeah. So the key word for me is simplicity, because those people who come up with the ideas don't want to engage with a bureaucratic system to say, I've got an idea. We just have to capture that. Stu, comment.
Yeah, no, that was interesting, Andrew. I suspect too that innovative people often don't boast about their innovative way of approaching life, and you see that all through life, so that's another problem too.
Thank you. Do you want to summarise those comments and then we'll move on to the other section, because we're really starting to move in what you're going to do next, yes. And I quite like that part of the report.
Yeah, so Councillor McPherson was spot on in respect to the barriers to adoption of the techniques that we've provided to staff to use to record their innovative ideas. I think there's a mixture that we need to consider going forward in regard to capturing those simply capturing the ideas such as the one Councillor McPherson referred to, but also supplementing it with those harder, more tangible, bigger metrics that will be coming from the EPO space. And if we can get that balance right, we'll get a really comprehensive view of how the organisation is performing in the innovation space. So it's a focal area for us, obviously an important one. If it's okay, we move on to page 12. And look, I'll just move over this really quickly. I don't have a slide for this one. These are really activities that are underway at the moment. You've heard about the Hale report. We've talked previously. We had expected it to be implemented and in operation by now. It shouldn't be too far away. It's in the test environment and with a pilot group of users at the moment. And the last update I had was that it's pretty much ready to release to the users out there. The problem has been that we got one of our developers who do the work, Enlightened Designs, their servers got hacked, and they couldn't access the information whilst they dealt with that problem. So we were kind of held in a bit of a holding pattern until that was solved. We've now resolved all those issues, and it potentially could be live even now as we speak. The next one is about the improved web search. It's not a biggie on paper, but it's significant from a customer perspective. These updates are happening right now, and it should add to that user experience significantly. The next one, which is around the centralisation of the resource use customers facing channels into the customer experience team. That's a fairly significant shift, and speaks to what we're trying to achieve across the organisation in terms of centralising some of the customer functions, or differentiating those that are more generic and simpler to those that are more specialised and complex. And those first cohort of functions, we're saying let's move them into a centralised regime where we can respond quicker, we can deal with them using better technology and support. And by that, we're talking about things such as service catalogues, training and development needs, and knowledge bases.
Neville, can you just inform us which page where you're at?
Section 24 and 25 of the report.
We'll just get through. I'll just get the Secretary to move us through on the screen to the appropriate one, which is numbered on your presentation.
Sorry, no, it's not on my presentation. This was just on the report. Sorry, okay. I missed this one out.
So we shouldn't be sitting on innovation goal area now, should we?
No. So we'll move on to this next bit, which
customer experience transformation program. Yep. Okay. Thank you.
So this is a fairly significant piece of work that's been a long time coming. And as it says under section 27 of the report, where the details highlighted, that it is an ambitious body of work, and it is about really ensuring that our customers now, but certainly our future customers, can access our services in a way that is really meets their needs and expectations. As you can see in the diagram in front of you, it's timelined between now and November, and during that period we'll be developing up what the requirements are from a budget perspective, along with obviously all of the bits and pieces that will achieve what we've talked about here. Now, we are not expecting huge budget demands in the short run. Perhaps in the longer period around the LTP we may do. We haven't defined them yet because we believe there's a lot of capacity and capability distributed across the network that can be harvested once we get a better understanding of how and where all our customer service delivery is occurring, because it's occurring all across the organisation in multiple pockets. So this program is about unveiling and uncovering it, understanding what each part of the organisation is doing from a customer perspective, and then how we bring all of that stuff together where it makes sense into a centralised location, while allowing the subject matter experts, those detailed pieces where specialists need to be involved in their areas of expertise. and then getting the transactional relationship between the general activities and the specialist activities really refined. And then over time, starting to shed some of the general activities through automation, self-service and other options. So it's a big program of work. We do know that it will require money over time, but year one of this is really about understanding where we can get and harness benefits from across the organisation by releasing capacity. So that's just an update really on that piece of work. As I said, it's a pretty significant one, and ELT are very focused on it, and the sponsor, I'm the sponsor of the program, but we're all involved to varying degrees in the delivery of the program. So happy to take questions on that one if you wish. Okay, if we'll...
Next question, you've got the refocus update.
Yeah, let's move on to that.
Andrew's got a question first.
Oh, okay.
Chair, I'm happy to move the paper.
Right.
And
So,
in so doing,
yeah.
if I could just make a comment, Neville, I'm not going to be around for too much longer, but I'll tell you, this stuff is really, really important.
It is important. So I'll just take your note of leave of absence from early departure from about what time, Andrew?
Oh, and
Because my political career.
Oh, okay. Oh, you don't want to leave. I thought you were leaving now.
But that could be right.
Thank you. Yeah. Yeah, all right. We won't record that. Just we'll take questions that everybody's read the report. But I'd like to have you comment about item 39, where you talked about recommendations for the update. What I've picked up is if you look at 39B, that's the same answer that we got a year ago, where what the corporate plan does is not well understood by the organisation. And this is yet again saying that, what is the corporate plan? Why do we need it, etc. So we seem to be missing the mark in terms of the understanding of the organisation. I just wanted to, and you talk about buy-in later, but really, how is that going to be? How are we going to move the dial, because it hasn't moved in a year?
Yeah, no, fair and insightful comments, Chair Barry. The recommendations are from the report that was previously done, and it was released in October of last year. So I was just reminding the committee that those were the findings of that report, and then what we're doing about it. Primarily about getting that buy-in and understanding across the organisation. So as you'll see in section 42 of the report, that we used that insight that we gained to undertake a further survey of the entire organisation, and I led a number of meetings with senior leadership teams and individuals who wanted to talk to me to promote that survey and the opportunity to get feedback from our people to say, so what actually do we need to do to be able to make this more meaningful and to resonate with you as staff. So some of those changes are itemised there, or what the focus was, so as the name, people had real problems with the name. They felt that this corporate title, even the word that it was a plan, really was distasteful for quite a number of people. We asked, what might we do to actually improve some performance in some of these goal areas, and what might we measure and how might we measure it, and what sort of education and communication do you require on an ongoing basis to resolve the issues identified in last year's report. And then in sort of the report then goes on to talk about what we did. And so we changed the corporate plan name based on the feedback to Ara Tupu, which That's means, right. A prosperous pathway.
That's right. And you're right that number 57 really highlights what you want to focus on. Does the committee have any views that we've captured everything on A to F under item 57? I thought it was pretty well cutting across all the matters that we needed to. So no comments there. So I think that's on target and constructive behaviours. Everything else, I thought overall, I thought the whole thing was hitting the right one. I have one question on page 19, item 64 on staff wellbeing. If you can see that under
Yes.
culture, I had a bit of a reaction that these measures that we're putting in place, 1 to 5, were really, to me, a bit like putting ambulance at the bottom of the cliff. It was waiting for something to occur which wasn't very nice, and we weren't really trying to be proactive around staff wellbeing. So I thought those measures, to me, were not, they were responses, not things that were measuring how well we were pushing staff wellbeing. All it was doing was measuring the results of, negative staff wellbeing. So just a comment on that area, please. That's the only comment.
Look, we're hopeful that we get through the pulse surveys, in terms of their wellbeing support, which you'll see is the second one down in that hierarchy on the right, and directorate wellbeing, that we'll start to get more, I guess, subjective feedback from staff about how they're actually feeling from a wellness and wellbeing perspective. And the drivers for that, in our view, are, or maybe they are lag indicators to some degree,
Yes.
will tell us that, well, if people are leaving, if they're not turning up to work, if they've got huge growth in annual leave balances, their balance between work and life is problematic. Why would that be? Why is it taking so long to fill particular vacancies? Is it because people have got an aversion to coming here? Yeah, we're seen as being ways of addressing the well-being needs of our staff. Messaging that is challenging.
I picked up all that they were lag and they were measuring it. What I'm trying to ascertain is what are the measures that the directorate might be putting in place to achieve well-being, as opposed to measuring it or monitoring it, or measures don't get a change in well-being. So I noticed above you're looking to change culture. So I understand that. It's how, and you're looking for behaviour change. Is that really where you're investing, or is there some other more nuanced approaches that you're looking in terms of facilitating so that people feel the well-being support as opposed to just measuring it?
There will be a range of things that will happen that will be driven from the top down, so from the chief executive, the executive and managers, that may be difficult to measure because they'll be in response to specific needs, even down to an individual level. And what we need to do is equip our managers and team leaders with the tools they need to be able to identify and manage individual issues or even group issues in terms of well-being. We haven't gone down to that specific level because it was really difficult to ascertain how do we capture and count that. That's why we ended up landing on these fairly hard measures, because they are easily identifiable and reportable. And they are lag measures, as you say. The lead measures are really around, are our people participating in the right type of learning and development activities? Have we got the right ones? Are they participating in them? Are we getting feedback to say that this is actually what they need as opposed to what we're providing them? And in our global HR system, which is a newly implemented performance evaluation system, we have an opportunity to put more culture-related goals in there that could deal with well-being. But what we're having issues with is the people using the system the way it's intended to, because it is new, and learning along the way, and then providing our managers and team leaders with more support to enable them to identify the right interventions and goals in the system for our staff to undertake and participate in, all of which is kind of designed to both build culture and address issues around retention and our employee value proposition. So they may seem a little clunky. Our challenge with trying to get things that could be measured that we think had some meaning associated with them.
Thank you, Neville. I'll take it there are no other questions, so we have a mover. And Stu, would you like to second? All those in favour, please say aye. Aye. Those against, carried. Neville, thank you for
everyone.
Coping very well with your challenges at the moment.
Thank you.
So thank you for that.
Cheers. I'll stay online. Thank you.
Goodbye. So we now move to the RSHL transition to a regional shared services organisation, and that's on page 23. And I welcome John Crane to present. John.
Thank you, Chair. So this is first of two papers I have to present. And this paper is about adjusting the shareholding structure of RSHL to position it as a broader shared service CCO for the regional sector. So if we can just go to the next slide, please. Thank you. I've just prepared a single slide on this just to talk through. Now, I don't expect you to read that, but it's really just a talking prompt. For background, RSHL is a not-for-profit CCO. It's been operating successfully for more than 10 years and delivering an increasing number of innovative collaborative solutions across the sector. The report outlines a mechanism for transition of RSHL to a regional sector shared service, a broader entity. And this has been signalled in the strategic direction and the business plan for RSHL, and it has been endorsed by the regional sector CEOs. The purpose of the transition is really to enable existing collaboration programs across the sector to be consolidated under that new entity and provide a structure that will better support these and future collaboration initiatives. RSHL to date has focused very much on one collaboration initiative, IRIS. As more and more collaboration initiatives are being delivered through the sector, a vehicle to both support those and to own and manage any subsequent assets that come through those programs. So the proposed transition will extend shareholding from the current 6 shareholding councils to potentially all regional and unitary councils, with an equal shareholding in the form of Class A shares. Class B shares will be issued and will remain for maintaining the current assets, Iris Classic, for the existing shareholders. Additional share classes can be added as more assets get delivered through the collaboration program.
John, we'll just finish this slide and then I'll take a question.
Yeah, okay. There will be, in the new entity, there'll be a maximum of 8 directors. Existing directors will stand down at the AGM in November and may seek re-election, and that will be through the normal protocols, voting by all Class A shareholders. The intent, in order to facilitate the transition, is for the shareholders' agreement to be signed by the 30th of August, and that will then allow that timetable for transition at the November AGM.
Right. Andrew, you got a question?
Yeah, John, will the new Class A shares rank pari passu with the Class B shares? In other words, equal in all ways?
The Class A shares will be equal in all ways. So
equal in all ways. Therefore, where's the voting rights?
Voting rights will be through. So in terms of the board members, the maximum of 8 board members will each have an equal voting right at a board meeting.
So sorry, the question I'm asking specifically is the voting rights attached to Class A shares versus the voting rights attached to Class B shares. Are either of those shares non-voting shares?
They do.
I don't know.
As I understand it, what we're dealing with is the A's are dealing with one area of activity, which is to do with the current Iris entity, and the A's deal with all of the new product. So I would understand that the limitations around the voting would be restricted to those areas, correct? And they don't have a cross-fertilisation between the two. They're distinctly separate, correct?
So my understanding is that these are non-voting shares, the management.
One's the A or B?
Both. So in terms of, and then the Class B shares is a mechanism for holding the assets, and the risk and the asset ownership sits with those Class B shareholders. New projects may deliver new shares of Class shares. So if a subsequent project comes along and delivers a new asset, a $10 million asset, with only 6 participating councils, those councils would own that particular asset under the
That doesn't make sense. Are there any other shares?
There is a mechanism to add share classes.
Yeah, but is there now?
Only at the moment, there are only the shares in RSHL are owned by the 6 shareholding councils in the current structure. The proposed new structure would create a Class A share, which would be issued to all participating councils, and the Class B shares would remain with those 6.
Yeah, but you said that neither of those shares have voting rights.
So the existing, so that's not quite true. Under the existing structure, there's 6.
So I mean, someone's got to vote.
Yeah, Class A shares will be voting rights.
Yes.
So sorry, Class A shares will be voting rights. Under the current structure, 6 shareholding councils have voting rights.
So we have 32%. Is that right at the moment?
We own 32.75%, I think, of the shares at the moment.
And you don't get a vote for your shareholding. All the shareholders
are equal. One director, one.
And do we write a check to become 32% shareholders?
We contribute to Iris in the current structure. We contribute to Iris based on that 32.75%.
Okay. Well, I can smell something going on here that sounds like we've written checks and we're getting our influence is not proportional to the size of the checks, and we're about to be diluted. Have I read that right? That's what this feels like.
So that is part of the constitution of RSHL when it was formed, that each shareholding council has an equal voting right, but the contribution was based very much on the size of the council and the ability to fund, with the, I guess, the intent that no council is paying for 100%. So for WRC to receive the full outcome and contribute 32% is still considered.
Well, we're in an electoral process. If any of the people who are standing for council were listening to this conversation, be fertile grounds to make whoopee here.
So, Mr. Chair, if I can just clarify though, for our 32% shareholding, we have had no additional voting rights ascribed to us because of that. So we have still just been one vote. And that's been a key discussion with our auditors around, is this an associate or not? But our investment into the Iris product, and I guess the shareholding of RSHL to date, and costs, so we've paid 32% of the costs based on the cost sharing formula, but that hasn't given us any more voting rights. So we don't, I guess, from an influence perspective, gain or lose under this scenario, be my read.
That's correct. And the intent has always been that this is a collaboration of equal partners within the same sector, working together for shared best interests and shared outcomes. So every single participating council has had a benefit of value from participating in the collaboration efforts from RSHL.
I mean, I think I get where you're coming from, Andrew, but if I was a small shareholder such as the West Coast, I don't think I'd want to be involved. If if my voting was proportional to my shareholder, because clearly the bigger councils would act in the interest of themselves and to hell with West Coast, you know. So I'm assuming that's why they structured it that way.
And also the way I've interpreted it is there's a need to go forward to progress and make this of more value. And unless the council went on its own and invested large sums of money, we really were at a crossroads of there's an advantage in having more parties join, and hence their fees will pay for the costs going forward, than it is for this council to invest heavily and then try and gain a fee from that. So hence I see the A and B, I can see some logic around the A and B shareholders. That's how I've interpreted it. Andrew.
Well, I absolutely disagree with that. I think it's a disgrace that we invest that money and we surrender voting rights. Because if we run with your logic, some numpty on the West Coast can, and they do, can behave badly and have undue influence. No one's saying that for a minute Waikato Regional Council with 32% of its shareholding is going to behave badly. I actually disagree with you, Stu. That's not going to happen. And if that's the perception of someone on the West Coast, that's their problem. This is another example of our council going, we should go to our ratepayers and say, oh, hi, we've invested some of your money, quite a lot of it actually, because those people on the West Coast can't afford to. And by the way, no commercial advantage and everyone has the same rights. And we're doing it the same. We're going to do it again with Reboot. We're going to say to the large happy family of LGNZ, we've invested 23 odd million. And by the way, you don't have to pay a cent. So it's just dumb.
So my answer to that would be, I read in the report that the current Iris program, of which he owned 32%, is coming to the end of its life. So it literally only has a couple of years to go of any viable ongoing. So what I'd say is that we all know when it comes to IT that things have and this has actually enjoyed a lot longer than I would have ever anticipated for a program. So the approach I've taken is that we have enjoyed from our investment quite a lot of value over that period of time. So that my view is, have we got good value return for the investment that we made some years ago? And the answer I came to is yes, this Iris has served quite well, all the reports that we have received. So what we're looking at is now a way forward, which you've got a new program, effectively. It's not the old one with a few tacked on things. It's actually a new program, and the various CEOs and whatever you said, how can we fund and make this happen? Is my view reflective of where the CEOs are taking it, and can you refine that?
It is. The CEOs and the sector as a whole are pushing harder and taking, I guess, greater steps towards collaboration, towards doing things together, obviously for better outcomes in terms of shared investment, for more consistency in how we operate, for a bigger voice with central government. The more we work together as a sector, the better the outcomes from a whole number of perspectives. If I can, just through the chair, if I can address the concern about the amount that WRC have paid in terms of our shareholding and our investment in Iris Classic. If we go back to the start of that project 12 years ago, ourselves and other councils were in a position of needing to invest in a new regulatory management system. The cost to build that system was $5 million. Had we gone alone, it would have cost us $5 million plus the $1 million per year to operate. We didn't go alone. We went through a shared service entity, through a CCO, to develop that asset, and we paid 30% of the $5 million, and we've continued to spend 30% of the $1 million per year that it would take to operate. That is still a good outcome for our ratepayers, a really positive outcome. The added benefit is that we have 6, now 7 councils with Hawke's Bay taking on the Iris product, who have worked very closely together to identify the best ways to work, consistent ways to work, to create a collective voice. And it's that success that has really generated the drive to more shared services, more collaborations, more shared investment, more sort of joint outcomes for the sector. So I certainly see RSHL and its function to date as a significant success story for the sector. And although we pay more than some of the smaller councils based on that sizing formula, we still pay far less than we would have done had we been going alone, and for a far better outcome.
Yeah, I take your point. It's a good point. I just philosophically think whenever people at scale use their heft and scale and checks to contribute to the family in a way where we give the 2-bit players a leg up, I absolutely have no problem with that. But I have a very serious problem when the 2-bit player ranks pari passu with me when it comes to any gnarly commercialisation decisions. And I do think, as a matter of philosophy, that we invest ratepayers' money, thanks to our scale. We should be able to stand in front of our ratepayers and said, we've joined a corporate group, we're sharing our scale and size to help everyone. And by the way, any commercial opportunities, then our scale will be recognised. And for some reason, this council doesn't want to do that. And they say, and the only rationale I've heard is because we're a member of the great local government New Zealand family. Well, it's a matter of philosophy. My question, Chair, is on page 53. All of the assets of RSHL represent the total equity of Iris. Is that comfortable with that? Yeah, that's how it is.
That's
Pretty straightforward.
How it is. Yep.
Happy to move.
Thank you. Andrew moves and Stu seconds. All those in favour, please say aye. Aye. Those against, carried. Thank you, John. You've got a second paper?
I do have a second paper. This paper is about the replacement of Iris, the future Iris solution, Iris NextGen.
Page are we on, Chair?
1, 2, 3.
And if we could do more slides. Thanks. Right, thank you. The objective here is productivity improvements, game-changing productivity improvements to the sector through sector alignment around consistent good practice processes supported by fit-for-purpose software. If I just give you a little bit of background around Iris and around this initiative. To the next slide. Iris, as we've previously mentioned, it's a core regulatory management system developed 12 years ago by 6 participating councils along with Datacom. The management, operation and enhancement of Iris over those years has been through RSHL, and we now have 7 councils currently using Iris after we won a competitive bid for Hawke's Bay's business. Iris NextGen will replace Iris, and the intent is to align the regional sector around consistent good practice processes. So this is really about, we're all operating under the same regulatory framework, performing the same functions, delivering the same services within our respective regions. We should be able to deliver that in a consistent, best way. And so a lot of work has been put into the good practice operating model by the 11 councils that have participated so far. So this program has been running for quite some time to define those processes, agree those processes, and then work together to conduct a thorough RFP process, which selected Datacom's Datascape product as a platform for Iris NextGen, and then a subsequent detailed discovery phase to really pin down those requirements and make sure both parties have got a detailed understanding of those, the solution design and the costs associated with it. So the program's now ready for Datacom to start building the joint software solution for the participating councils. Prior to then its deployment at 2 pilot sites and then the subsequent councils following that. They're at the point where the programme is ready to proceed, and so need that investment from participating councils. So the ask is for those councils participating to sign their commitment through the participation agreement. For our council, the target implementation for us is to start in April 2024 through to October 2025. So the activities ahead of our implementation are the build of the common solution and then the implementation of the 2 pilot sites before it comes to ourselves and 3 other councils at the same time. No, so sorry, just to answer that through Chair. This is Datacom's solution. So Datacom's Datascape solution. However, they will be further developing their core product to meet the specific requirements of regional sector in New Zealand. There are some unique requirements that aren't embodied in the standard product, but they're doing that as part of the standard product. So they're not configuring for or building software specific for WRC or for any other council. They're enhancing their standard offering, their Datascape solution, to include the functionality that New Zealand regional sector requires, working with us. So it'll be there, continue to be their product. In terms of the costs then, so the partnership agreement, if we just go to the next slide, thanks. The partnership agreement assigns 16.5% as WRC's share. This is different from our current contribution under IRIS, as we've discussed, and that's a reflection of 2 things. One is a refined sharing model that's been worked out through a number of programs within the regional sector, such as Rococo. Also reflects the greater participation. So that's means that the total investment in IRIS NextGen, and the shared cost of that, we will receive 16.5%. That means the cost to us for our contribution to the shared cost plus our direct to council costs is 5.63 million over 10 years. And that includes the cost, our contribution to the shared bill cost and the shared program cost, plus our license fee over those 10 years and the implementation here. So that's our 10-year cost. It does exclude WRC resources to become familiar, to train, to learn the processes and so on.
Let me ask a question about
You
that.
want to take a question there?
Sure. So John, the language on 22A caught my attention. These costs are the responsibility of each council and will not be shared according to the council contribution model. What does that mean?
That means that there are really 2 groups of costing. One is the cost to build the shared solution, if you like, the shared project costs. Then each council will have a cost to implement that shared solution at their specific council. So there's a cost to implement IRIS NextGen here at WRC. There's a cost to implement it at Hawke's Bay, a cost to implement it at Taranaki. Each council will bear that implementation cost rather than it being a shared cost. And that's because it's probably a fairer model. Yeah. The implementation here may be more costly than it might be at West Coast.
The costs lie where they fall.
Yeah. Yeah. So under that second bullet point, over the 10 years, that 5.63 is the shared and the direct cost to council. Is it flat, that amount, or does it go in a curve?
I've got a chart which will show
Thank you.
Some of that. Our current contribution to the classic, you call it IRIS Classic, the existing IRIS is 440,000 per annum. That's what we contribute for that shared software. And that's reflected in the current LTP. We do have an additional 200,000 budgeted in this year as part of the initiation of IRIS NextGen. However, that 5.63 million over 10 years has not been reflected in the LTP because it wasn't known at the time of the last LTP. It was signalled. We knew IRIS NextGen was coming at some point, but it was too far out to have any idea of the cost and to be able to accurately reflect that. As we progress with the NextGen programme, the investment in the current IRIS will drop off. We'll minimise it. We'll keep it on effectively life support. There won't be any new enhancement. So that contribution of 440,000 a year will drop off. And so there will be some freeing of some of that budget towards IRIS NextGen. And I've demonstrated that on a chart shortly. That shortfall then over the 10-year period is about 2.2 million. So it's 5.63 million over 10 years. We have the budgeted cost for Iris over 10 years. The cost over 10 years to transition is 2.2 million over the 10-year period. Post-transition, once we are on our Iris NextGen and all the existing councils have stepped off the old Iris, the annual cost for Iris NextGen is lower than the cost of the current Iris solution for a much better solution.
That's good.
If I could just go to the next slide, please. I've tried to model this, and this is quite difficult. The grey line is the 10-year Iris NextGen cost. So this is where, to your point, Chair, this is where there's an implementation peak that comes in that FY 24-25. Now this could be flattened out through borrowing, so this could be smoothed out some more. The blue line is the current Iris budget, which is 440,000 a year plus that extra 200,000 for the initiation this year, and that's in the LTP. The orange line is the cost to remain on Iris Classic. Now the reason that's higher, that's approximately estimated at 750,000 a year, because as we implement Iris NextGen, we will wind down the costs of current Iris. Once everyone's off, if we were the sole council remaining on the old Iris, we would cop the whole cost. And fair enough. So that 750,000 per year would be ours alone.
Do we have a point at which that dies?
Now, the note I've made there is that orange line is kind of theoretical, because somewhere along that line, the old Iris will die and we will have to invest in a replacement. And if we were to do that alone, it will go way off the chart. So it will be 10 times more.
So is there a point at which it doesn't get supported?
The software, that's entirely up to us. So at the moment, this Iris itself is a bespoke, custom built solution. So we could ask Datacom to continue to enhance it, to continue to swap out technology. All that cost would be ours.
Can I interrupt there? If we're sitting in shareholding with others, does it require all those shareholders of the current Classic to want to bail at a particular date together, or can anybody just drop off when they feel like it?
I suspect, to be honest, I don't have a specific
because
answer.
I would have
thought likely
thought
to happen is the other 5 councils would drop their shareholding of the Class B shares.
That's
we
right.
would be left with the asset.
So we need an exit strategy. I would have thought that as you get a new product, they'll be less likely to engage around the old product. So when we go to the council with this, given that it gets a recommendation, we really want to make sure, one, this graph is up, and two, a comment around how we exit from the Classic. And what are the other councils going to do, and what are they likely to do in that period? Because this goes on to potentially 31.
So the agreement at the moment, or the working agreement, is that as all the existing Iris councils drop off and move to Iris NextGen, once the last one has moved, that's it. The asset is retired. It's no longer operational. But if we were to remain as the sole council on it, then we would assume ownership.
If there's only 2 of you, wouldn't you want to force the issue because it's costing you money? Because you've got X amount of money, was it 600,000?
3/4 of a bar.
And this is the driver for trying to continue the momentum on this project. The sooner we can all get off our legacy systems and onto the new system, then we reduce the amount of double up, where we're paying still some costs to the old system.
So I just want council staff to think about how we will address that. That's all. That's that exit strategy. You got a comment on it?
I have about the exit strategy. I mean, I've got a lot of faith in Datacom. I think they do good stuff. I chair a little organisation that's confronted this very same issue, and we decided to nickel and dime the software for as long as we could, and we got another 3 years out of it. And that actually made us quite a lot of money making that decision. And my inclination here, because it sort of feels a little bit like we're presented with a lay-down misere. There is, we're really skint when it comes to options, and it's a foregone conclusion. And I guess we just have to suck it up. But Chair, I would like John to give me or the CFO on item 21 the total program costs of 27.25. In view of what we've done with IT, have we earned the right? Is there any wobble in that number, or can we assume that Datacom, in relation to Infor, for example, that Datacom, this is far more well-defined Gantt chart, the obstacles are known, there's going to be very little surprise comes in APIs if you've got to write them, or any of that other detail stuff. And so we're not, and now I'm speaking for all of the councils, whoever the lucky people are sitting on that board, are not going to be confronted with an oh shit experience like we've had with Reboot.
Fair question.
I can absolutely cover that. There's a couple of things there. An awful lot of work has been put in by the 11 councils and RSHL to mitigate that risk through the RFP process. It was a very robust process. We had a number of very competitive bids. This was the best proposal by a long way, both in terms of cost and in terms of risk and functionality. We do have a long-standing relationship with Datacom. It's been successful working with RSHL. Through the discovery phase, so subsequent to selecting Datacom as the preferred option, there was then another 6 months of work by the participating councils and their staff, and I think I've identified in the report how many staff were involved. 6 months of work with Datacom through that discovery to really pin down the requirements in detail. And that's allowed two things. One is a more detailed costing from Datacom and an agreement to fix price it, so that they will fix price that 27 million, or that their Datacom component of that, once all the councils are on board. And that de-risks it by quite a considerable amount. The fact that it's also a collaborative initiative de-risks it as well, because any council is not wearing 100% of the risk. They're not wearing 100% of the cost, and they're not wearing 100% of the risk. So should there be any cost implications, it's shared across the participating councils rather than one by one. But that fixed price really does go a long way to mitigating that. Plus our track record of working with Datacom, you know, they have been extremely reliable, predictable and accurate with their costings through the years that we have been associated.
As my subsequent questions, John, there's probably 3 of them. Will it be an agile build environment like Reboot?
Datacom do operate agile processes, but again, this is Datacom's product that they will be configuring and enhancing for us.
Is there a, have you done the same, has there been the same approach to the needs analysis as you did with Reboot? In other words, there's the outcomes, there's the blocks, it'll work? Or is it because it's Datacom's original code, the needs analysis is not as important? In other words, I just want to make sure that someone has sat down before they've agreed to that contract, and there's no wriggle room in the needs of this project.
Again, this has been very robust, and the approach hasn't been to, we're going to adopt the standard datascape. The approach has been the 11 councils to work out that detailed best practice operating model, and for Datacom to absolutely convince everyone that their solution will meet them.
So
thank you, Chair.
More on Datacom have to meet the requirements.
Yes.
So are you happy to move?
I've just got a couple of quick slides
Sure.
to finish off, if that's okay.
Yeah, we're happy. Basically, we've all read through it. If you want to make some more points, what I'd say is, and I welcome any committee members what do you think are the key things that the council wants to hear out of this? I think they've got to see these graphs and they've got to see the information you've presented in this report to support the written. The question I do have is, do we need to inundate the council with 100 pages?
No.
I like this, what has come up here, and I think that is the crux of it. And then there should be a summary of the 100 pages coming together. Is that what committee members would like to see? Would you be happy? Yeah.
No, I wouldn't do it that way.
Which way
The
would
way,
you? Yep.
the way I would do this, and if I'm at the council when this comes, I would say we're coming to you to join a group, to build some software. We haven't, we've struggled with Reboot. The risks associated with this program are so much less than they were with Reboot. And those few questions that we've asked about needs analysis, how much code has to be cut, the risk around Datacom, etc. You just lay that out. I don't even know if I'd put that up. I think that's too nuanced. This is really about risk and getting the risk out of that investment. So that's all I would do. It'd be a one-pager.
Yeah, but the reason I would have this sort of thing up is a number of councillors want to know what the ongoing cost is, and they want to understand the old product and the cost of the new and how it goes forward. How we fund and get rid of that peak is another issue. But I think there are a number of councillors who would welcome that sort of simplistic approach to give you some idea around costs. Because that is, the reason I say that too is what goes with this is the new council in 2024 is going to be considering the costs of this to, let's say, update the LTP. So they're going to want to see this sort of information as being considered by the full council in the past, and we can then refer back to it. So that's why I'd like to see it there, so that there's plenty of information informing a council. That's just a view I have. Yep, comment? Yes. It could be addendum. So I'm going to take your button off and then.
Sorry, thank you, Mr. Chair. Just to clarify in terms of process, I guess what's being sought is that both of these recommendations actually come into the August council meeting. So it's all for this report and the shareholding around the new shared services entity, both section B recommendations. Yes. So they will come to you at the end of next week. John, I think we can just have a presentation that can step councillors through based on the discussion here and the points that Councillor McPherson's asked to be clear through that. So it won't be a paper per se coming to council.
Right. So we have a mover and a seconder. I'll put that. All those in favour, please say aye. Aye. We're going to have, we can have a 5-minute break, which is probably the thing to do because we have to have a break anyway before midday. So we'll take a 5-minute and then we'll crank through the next one. Hey, thank you, John. Thank you. And thank you for those reports. It's been a worthwhile discussion.
Thank you.
We have to have a 10-minute break according to the boss here. So we have to have a 10-minute break and then we'll aim for lunch at 12:30. We should be able to crank through the other ones. Yeah, we should be able to do that. So 10 minutes and we'll be back at, okay, we'll reconvene. And we are reconvening with, where are we up to? We're on to item 8, which is on page 131. I got it right. CoLab audited, CoLab audited report, annual report to 30th of June. Janine.
Thank you, Mr. Chair. So this is the, I guess we've talked about RSHL of shared services, which is the way that we collaborate across the regional sector. CoLab is obviously our shared services entity within the region. This report presents for the committee's information CoLab's audited annual report for the year to 30th of June 2021. So they have completed another cycle, obviously, since then. The delay in being able to bring this report to the committee reflects delays in the completion of the audit by Audit New Zealand, but information is provided there for the committee's information, just noting the key achievements of CoLab for the 2020-21 financial year.
Right, thank you for that. It really, what it demonstrates is how a coalition of partners can achieve things. So, yeah, I'm happy to move that. Do I have a seconder? Yep, Stu Kneebone. All those in favour, please say aye. Aye. Those against, carried. So we now move on to item 9, which is the rates 21-22 rates information to 30th of June. Janine, page 183.
Thank you, Mr. Chair. So this just provides the committee with an update on the status of our rates revenue collection for the last financial year. We ended the year with an overall collection rate on current year rates of 96%, so marginally behind where we have been, but nothing of note within that. I think we just called out when we reported to you in December, the collection rate was looking slightly lower, which was really the delay in being able to process the November penalty run and the follow-up action able to be completed as a consequence of that, but that has largely corrected itself over the 6 months since then. We've provided the committee with an update on the remissions that have been granted for the year. We've already touched earlier in the meeting around the hardship remission provision that Council had put in place, and the reality that that really isn't landing perhaps where it was expected that it may have, and so the need to revisit that. The other key change in terms of the remissions granted is with the change in rateable status of Māori freehold land, so going from rateable to non-rateable, so comes out no rates assessed on it rather than us issuing a remission in relation to those properties. And we've also just noted there under paragraph 13 the value of rates that have been written off over the course of the year, again through change in legislation last year. They sit under the delegation of the Chief Executive, but we report them through to you for visibility. There's a number of graphs that are there that show, I guess, the trend in rates arrears by territorial authority, some in terms of the total value of rates and some as a proportion of rates outstanding. Obviously,
just had one question there. On item 15. It says the graph says for a 3-year period. It seems to, of all the graphs, they all made sense to me, except for the skyscraper around Hamilton City on the 3-year. So is that orange graph is reflecting a 3-year situation, and then the 2021 is so low. So why is it such a big skyscraper? You know, that was the only graph I couldn't get my head around.
I think, and I think the next graph down is probably the more relevant one. The first graph under 15 is based on the dollar value of rates outstanding in an absolute term, which obviously changes year on year as rates go up. And so you would expect actually those lines to continue to increase as our total rates assessed in each area go up. So I think the most relevant one is around the percentage,
that makes sense.
which we can see a small increase between 21-22, which is reflected in that overall collection rate of 96% versus 97% in the previous year.
Number 18 is a graph which again has that little bit of a skyscraper for Hamilton City.
Which again is from a dollars.
It's just
from
dollars.
a dollars perspective rather than a percentage of total rates assessed, which is normalises those results more.
Any other questions, members, for this paper?
Just also a question / comment. With the arrears or the response to people being able to apply for the relief, just thinking of the conversation we had as a brand new council earlier in the year, there's going to be other events, COVID or whatever the hell they are, that incentivise successive councils to go down that track. You, Janine, obviously hold a lot of information about what sort of response was, but I just wonder, and I think I've said this before, whether we shouldn't sort of formalise that somehow into some sort of report that successive councils and successive management can call on to better inform those sort of discussions. Because ours was, I think in hindsight, it's always easy to be, our hindsight was perhaps a little bit reactive and maybe not that well informed.
Yeah, through you, Mr. Chair, that discussion is probably really well captured in the reports to council at the time, which looked at various considerations around what a remission policy could look like. The fact that at that stage we were one of the few councils that doesn't actually have a hardship remission policy, but with looking to the DIA rebate scheme as sort of our effectively our income test or our hardship test, of noting across the region, there's a lot more uptake of that DIA rebate than we're seeing translating into the actual applications that we're receiving. So I've gone back to that report a couple of times to sort of just work through that logic that was applied at the time. So that's probably a record that stands us in reasonable stead.
Yeah, okay.
You want to hit? Have you finished?
Well, yeah, Max just said, is that enough? And look, I don't know. I mean, yeah, what do you think?
I think it's a bloody good question, and I think the answers are a reasonable attempt. But I think what you're hearing is we want to institutionalise some learnings. All that stuff at the time was sort of ex ante, if you like. Now we're ex post. It would be really nice to say, what are the 4 or 5 things we learned? Because I would say, to Stu's point, it's yet another example of a superb, and I'm speaking specifically now about zero rates increases. It's a wonderful example of a beautiful political decision, but a seriously dumb business decision. And with the benefit of hindsight, armed with someone who had institutional knowledge rather than a chairman who was hell-bent on a political outcome, we might have got ourselves a better, more appropriate outcome. Because I think what the opening of this meeting tells me, and what this discussion tells me, is when you try and assess the depth of someone's wallet, and I learned this in vet practice, if you try and assess the depth of someone's wallet, you will always get it wrong. And so willingness to pay, which is an economic concept, is something that we shouldn't try and second guess. And so I think the temptation as a new council is to say, and I suspect we're going to hear it from our next speaker, Brian, we're going to hear globally, there's never been more fear in the markets than what you see now. In New Zealand, we've got inflation that's rampant. We've got a whole bunch of macroeconomic settings that it will be very tempting as a new councillor to say, there, electorate, we'll help you. We think we know what the best thing is, and it's zero rates increase and a really, really generous remissions policy. Well, I think where Stu's going with his question is, with the benefit of hindsight, what did we learn? And I think we've learned that we might have been better just to have a modest rates increase, and as long as we rank equally with the TAs in terms of rates remission, anything over and above that was a waste of time, because that's what I think I'm hearing, and I thought that's where Stu was going with this question. And I would, if that is where you're going with the question, I would support you.
Look, it's always hard to second guess what a new council
Yep.
will decide to do politically. So, and
Yeah,
I wouldn't
and-
expect that.
Yeah, and I mean, my recollections of that time actually of trying to set an annual plan with a new council was the zero rates budget was actually about the council's fourth attempt at setting a budget for that year, because we started with what had been set by the previous council through the LTP. That didn't land. We were sent back to do some more work. We were sent back to do some more work, and then COVID hit.
Yep.
So I don't think these things, I guess, can never be seen in isolation of the other conversations that were actually happening at the time as well. And I guess the beauty of the organisation is we have a record of all of those discussions through these meetings and agendas. But I take the point, but I think it is that conversation still in context of everything else that had come before it as well.
It's always wise to be informed in retrospect. And even the advice we had from our illicit advisors, informed advisors, was that it was an expectation that the economy would retract greater than it did during that phase of COVID. The thought was that the world economy was going to really react badly. And that didn't show up to the degree which was expected. So to that extent, we knew, and retrospective, we'd known that we might have taken a different view, but council didn't know that at that point.
I also think, though, there seems to me to have been a clear message to us that regional council rates, as compared to the district council rates in terms of size, didn't figure highly on something that was a concern to people. Because despite the economy not doing quite what it was predicted to do, there was no doubt there was a lot of people in hardship.
Yeah, true. I'm not underplaying that.
Yeah. No, I'm not saying the word, but I'm saying how people viewed the regional council rating component of their outgoings clearly wasn't as significant as what we suspected it might have been.
And I think with that also the value of that remission, that based on the number of applications that we thought we might see based on DIA applications, meant that, it was a very small contribution, 10% of the average general, residential rates bill, so $30 odd a year. Yeah. The time and effort needed to get a return of $30, I don't think has landed for a lot of people.
Thank you. I will happily move that staff recommendation. And Stu, will you second that? All those in favour, please say aye. Aye. Those against, carry. So, second that. Tenders board contracts. Ginny.
Thank you, Mr. Chair. So this is, again, just a standard report that we bring to you every quarter, gives you visibility of the tenders that have been considered by the tenders board, which is made up of the chief executive and directors. A number of these you may have seen yourselves as they have come through the contracts committee based on the multi-year contracts with a value of more than 500,000. Happy to take any questions or points of clarification from committee members.
Any questions at all?
Just a comment, were you aware, Matt, that EcoFix had changed hands? If you see the original ones, the May one here was with EcoFix and it's now known as Rentacool.
Yeah.
That's what?
Rentacool, they took it over.
Rentacool, I think that yeah. So Kevin Christie, I understand, is staying there as a manager.
Staff staying there.
Yeah, the guy that used to own EcoFix for some time.
It'll be part of the deal, I guess.
Yeah. But
question here.
I don't know which page you're on, but I'm on page 193.
Yep.
The Nawai or Waikato Senior Catchment Officer, what's the term for that? That's a contract variation. That 384,000 for that contract, how many years is that over?
That's a very good question. I would need to check that. I want to say that it was an 18-month contract to start with, extended for another 12 months. It's in that sort of order of magnitude.
Is that one person?
Yes.
One of ours? That's not obviously.
No, so it's not one of our.
And those are fully absorbed costs for a year's work.
Yeah.
Does that?
I can confirm back for you just exactly the contract term for that.
Does that seem?
I know there was a lot of discussion on that through the tenders board in terms of why that was required through a contract specifically as opposed to as a staff member in the organisation. I think there was existing knowledge by the contractor in that area that was deemed to be important for the programme's continuation.
Well, hang on a minute. Chair, does that pass your sniff test?
It's
one person, 1.5 years work that's got some institutional knowledge, 384,000?
I was certainly looking as, this is an external,
Yes,
and I would, my view was the contracts committee have looked at this.
That one won't have gone through the contracts committee because it's under the $500,000 threshold,
Okay,
but it
so,
went through tenders board.
So tenders board, sorry, that's what I meant.
Yeah.
Tenders board. So tenders board, from what I've seen of tenders board, they have, they really look at, examine things quite acutely. So are we able to, if we move on, because we haven't got an answer to this right here now, are we able to inform that question that has been asked, because we haven't got an answer here, are we able to inform that for a bit later in the meeting and leave that question on the table and get the answer?
I'm happy to go back to the agenda for that meeting and just clarify the detail of that.
I think it's a fair question you're asking, so we'll get an answer for that.
And hang on, the second question is reboot. The million that's asked for there, that, can you help me understand that's how that just didn't go to the tenders board, did it? That's something that's come through the project reference group. It's just I don't recognise the symmetry of that number.
Yes, so it, I guess there's, within the delegations manual, there's obviously thresholds and around the decision-making process of if it's been through tenders board, if it's been through contracts committee, how much a contract can be varied outside of that. Certainly that contract has been through the contracts committee previously in terms of those services of our functional lead for reboot.
And you, as I understand, you've got a briefing coming up again?
Yes, so there will be a report on reboot to come to the council meeting next week. Prior to that, once the agenda papers are out, it's my intention that we can have the key projects reference group members who are interested in that project, a briefing with them on Monday next week.
Well, let me ask the question a different way through you, Chair. Negotiate Consulting are going to be paid $1.07 million. I'd like to know how many people does that buy us and for how long?
So that contract has been in place since project initiation.
Yep.
Is
this Bjorn?
So Negotiate Consulting is Asbjorn's company. This is not Asbjorn himself. It is someone who works for him, a contractor.
So one person?
So it's one person who has
long?
been on contract with us since, it would be 2019.
So is this what the member is asking?
How long is it going to take us to burn $1 million?
Yeah, that's the point.
So that's through until next year.
So that's how many months he's asking?
So that was my comment in terms of the contract being in place since 2019. So from the initiation of the project This is the functional lead who has worked with us throughout the duration of the project in varying levels of input. So for a period of time that was full-time and part-time effort on an ongoing basis.
I'm sorry, Ginny. It doesn't answer the question. I'm trying to figure out, here's a point in time, what's the burn rate and when does it finish?
So my apologies, Councillor McPherson. I thought I had answered that question in terms of the contract having been in place since 2019.
Yes.
The contract will extend through until the project is completed next year. The burn rate over that period has been variable depending on whether Donna, who's the contractor, has been with us full-time, which was the case in the early stages of the project, versus at the moment her availability of 1 day a week.
So just to give more clarity to it.
And this has been through contracts.
So Donna's, the current budget provision is allowed for Donna to what point, roughly? Broadly speaking. Because $1 million coming in to add to that, isn't it? Because she wouldn't have been employed.
No. So much of the spend, so effectively the 866,000 is within already approved budgets.
Oh, okay, gotcha.
So this is not addition. So it's not total new spend. It's acknowledging that the project.
So 140,000 additional.
The project has extended. Donna's support for the project is required to be extended.
So I'm going to play back your answer. 50 months, $1 million. Burn rate, 20,000 a month in a straight line, one person. Is that what's going on?
So it is one person, yes. We can go back to the reports which you have received previously around her daily rate and her hourly rate. I don't have those at my fingertips at the moment, but I can certainly look at that.
So just to give further clarity to that,
works out at $1,200 a day. I didn't pick
up that it was just one person. I picked up that when somebody is an organisation, one, they have overheads, there's beyond oversight, and there's various other things. So that's how I interpret it, that it was part of a company's charge out rate as opposed to engaging one person. Is that, am I being reasonable?
So I guess we have engaged Donna effectively at a consultant rate, which is the expertise, the level of expertise that she is adding into the project. That work is, in terms of the contract rate, I think is set on a daily rate. I have a number in my head, but I would like to confirm that before stating that is the rate. That information has been before the contracts committee previously in terms of the previous contract value.
Just summing it up, the recommendation is this is value for money with it, to achieve the outcome.
Yes, I would go further than value for money. I would say Donna has been instrumental in assisting us with the overall design of how the solution needs to fit together and operate as an integrated system. Her continuity within the project will ensure that we actually get that running through right to the end.
Any other comment, questions? Stu, you happy?
Yeah. I was just going to say that Ngāwai or Waipa one, that was quite a bit of MB funding and WRA funding as well too. So, and it was only 3 years. I'm assuming it possibly has been extended for reasons that lots of our other work programs.
Yeah, I will, when we have a break for lunch, I will dig out that report and just come back to the committee with an answer around.
So are you happy, Janine, we'll leave the recommendation lying on the table.
I can come back to
and we'll come back to consider the item after we get that answer. So we'll now move on, leaving it lie on the table for the moment. We'll move on to Tina's board contracts. Am I in the right
No,
place?
so we're up to draft
no,
financial
draft
performance.
1, yes. We're going to 196.
Correct.
Page 196.
Thank you, Mr. Chair. So this is presenting for the committee the draft financial performance results for the last financial year, as well as an overview of the requests that have been made to carry over budget unspent to 30th of June 2022 to into the 22-23 financial year. So overall, as is noted, as at the end of June, our operating performance was 10.4 million favourable to the March forecast. A significant proportion of that funding is requested to be carried over to the next financial year to allow work to be completed that would leave us with a $2 million unallocated operating surplus. Right. So noted there under paragraphs 8 and 9, so we note revenue being unfavourable. We'll hear some more about that in an agenda item to come up in terms of the investment fund performance, but largely offset by drawdowns from the investment equalisation reserve. Noting that total cost of service was $11 million favourable. Of that, 3.75 was a delay in the timing of the payment of Council's next contribution to the Waikato Regional Theatre. So I think that payment went out in July rather than by the 30th of June. And also just noting that overall our staff's salary costs were about $1 million favourable compared to forecast. Noted there the key capital expenditure variations compared to forecast, which was we were about $10 million underspent in terms of capital, roughly 50-50, 60-40 maybe between operating capital and infrastructure capital. As noted, so there's a summary in terms of the financial performance on the top of page 198 that just takes into account funds that move between financial years that get considered through forecasts. Total operating carryovers that are requested in the order of 8.9 million, and if all of those were to be approved, and they have been subject to scrutiny by the executive leadership team, then we would have an unallocated surplus funds of just over $2 million available for council consideration.
Assuming the carry forward.
So that's assuming we carried over, and so some of that surplus to allow work to be completed in the new financial year. I think we'd noted there that in terms of that surplus, one point noted in the report is meeting council's legal costs in terms of the judicial review, but also potentially looking for some funding from there for recognition and retention of key staff or really high performing staff. So a small fund available to do that, acknowledging vacancies that we have, turnover levels that we are currently experiencing across the organisation. I'd probably just note, coming back page 199, have provided that overview of both operating expenditure carryovers and the capital expenditure carryovers, which show about $36 million of a work program moved from previous financial years across to 22-23. On top of that, there's obviously through the annual plan additional investment that council has signed off on as well, which has been a matter that I've highlighted with the executive team, and the need to be very conscious and diligent around the prioritisation of what we can actually achieve over this coming year, acknowledging that there are parts of the organisation with higher levels of vacancy than we would traditionally see. And so balancing that desire to do work with the ability to do it, and I think reflecting some of those earlier conversations with the committee around staff wellbeing as well.
Thank you. I'll just make a comment there, Janine. I really think those last comments are very important because I reflect back on a number of times that this committee and myself have commented on how we thought there was some real issues about logistics, cost increases and resource availability a long time ago. And we didn't believe that the organisation and people within it, and you've just expressed your views about the diligence to what we can achieve. I think I would like to see this committee support your narrative within the organisation to ensure that the ELT and others look very closely at what is achievable, because we are constantly seeing now where budgets are not achieved and we're getting further and further away, particularly on capital works. And when we have logistics, cost increases and resource issues tackling us, we don't want to be setting down a program of work which is never achieved. And I don't think we really need to change where we're at in terms of how we respond to capital works in those areas. So you have if the committee is of the same view, I would like that message to come through in our minutes, that the message comes from this committee through our Chief Financial Officer to ensure that ELT and parts of the organisation are seriously reflecting on what's possible in the current environment, and that budgets reflect that and that adjustments be made. So if the committee is of the same mind, I'd like that to be noted as an action point. Andrew.
I've got 3 questions. The first one is, and I was reading these papers on the last flight coming into Hamilton last night, and I was nearly asleep, but I read bullet point 3, last line, and it says, the decrease in retained earnings, open brackets, general ratepayer funds, close brackets, is 295 negative 10.4 million to the March 22 forecast. There's a word missing.
Yes, my apologies, I picked that up. Should be favourable. As
a departing councillor, can I ask through you, Chair? You do a great job with your papers, Madam CFO. But please, I think the readability, these papers are so important. They're important because they form a record, and they're important because they're the basis on which we're going to make a decision. So I think having an author and an authoriser who are the same person is always fraught. Okay, so the word is favourable, it should be in there. Second question is, and we are on the record and we're in public, the judicial review, do you have an estimate of what that's going to cost?
Through you, Mr. Chair, I think the Chief Executive has made a statement in that of saying costs in excess of 100,000. So final costs have not landed yet, so but that's on public record.
I'm assuming through you, Chair, the CFO is saying the number will be somewhere between 100 and 200,000.
It'll be in excess of 100. I wouldn't have thought that the CEO would make those comments if it was at the higher end of the figure you've talked about. So the reality is he is going from a point of view of not having received any invoices. So it's a bit speculative, but it's come from a baseline of having a fairly good handle on what it might be. So that's the sort of figure that's been publicly announced. Yeah. And, you know, the evidence isn't in yet in terms of what the invoice will be, and we just have to wait upon that.
Can I assume that that number includes sorting out the legal fees for Councillor Litchmark?
that is included in that overall assessment.
Thank you. The CapEx carryover, to your point, Chair, I'd like to delve into that a little bit, because last year carried over some projects that we'd got as a result of the COVID shovel ready. Can I assume two things? The actual work projects that you had in your mind at the last carryover, those projects are no longer in this year's carryover request? Because if they are, I would support what the chairman's saying. If they aren't, that tells me that the executive are saying, let's get rid of the old projects first. Because I think if we've carried over something last year and you're asking for us to carry it over again, that's a really bad look.
So through you, Mr. Chair, that's one of the checks that we do in terms of what was carried over last year, and is it a carryover on a carryover on a carryover, to make sure that that isn't occurring, or if it is, that it's, you know, potentially for reasons outside of our control.
So for the record, that's not happening?
It's not happening.
Okay, well then I'm with the chairman. And appertaining that, can I assume that the OAG and our audit have applied their minds to this?
In terms of for the last financial year, audit haven't turned their minds to these financial statements yet at all. I'm still awaiting confirmation of when they will actually be able to undertake the audit of our annual report.
Could I respectfully suggest, through you, Chair, that there's a note that would reflect the embodiment of this conversation? Because for an averagely informed reader reading our set of accounts, it'll be pretty hard for them to look at the numbers and get the look through that you need, that this nuanced conversation, which is an important one, as the Chair said, we need to be able to assure the public that we're not having a carryover of a carryover of a carryover.
So through you, Mr. Chair, in terms of the capital works program, what we include in the annual report is a statement around what was the capital works program that we had planned to do, and what are the projects that we haven't been able to deliver this year and why. So we are transparent through that in terms of what we haven't been able to do.
That's really exciting. I'm looking forward to reading that, and I'm looking forward to reading the unfunded
Yes,
mandates as well. Thank you, Chair.
Same. Stu?
Oh, it was just on that carryover stuff. I noticed it's quite obviously, not unexpectedly, quite a bit from ICM, making sure in terms of stop banks meeting specification that some of that stuff gets prioritised over other restoration projects, which I'm sure Greg will be well over. But
yeah, I was looking too in the same area, and I took some comfort from, there's a report saying the percentage of meeting the levels of service around stop banks and so on, and it said we were meeting those levels or within sort of 1% of it, and the critical areas were actually exceeding the benchmark measure that we set. So I took some comfort from that report.
Through you, Mr. Chair, there's also a report that will be coming through the Risk and Assurance Committee around some of that asset performance information and how we're stacking up in terms of those assumed levels of service and asset condition assessments.
So happy to move, Andrew? Andrew moves, Stu Kneebone second. All those in favour with this draft financial performance and requests for budget carryovers? I'll put that, all those in favour say aye, those against, carried. So we now move on to item 12, which is 214, page 214, which is the end of year non-financial performance results. Janine again.
Thank you, Mr. Chair. So this is the companion document, or report, I guess, to the previous one of looking at our non-financial performance results. Obviously measuring how we've gone against the performance measures set in the long-term plan. As noted, and I think as we've been reasonably consistently reporting to the committee at the end of the year, we've got 73% of our 51 measures achieved, 4% achieved in part, and 23%, 12 measures not achieved. In terms of those measures not achieved, one of the key areas where that has occurred, which again we've reported fairly consistently through to the committee, is in relation to public transport and the impacts that COVID-19 have had both on passenger numbers as well as driver availability, which has resulted in reduced timetables able to be serviced.
Yep.
The information that's contained in the report will in essence form the content for the annual report, subject to review by Audit New Zealand. So as noted, haven't had any confirmation of when that audit will be able to be undertaken, which will result in the new council needing to adopt the annual report itself. But prior to the content going in for that pre-audit version of the document, welcome any feedback or comments from the committee on what's been provided to you.
I was quite happy with what was put there. So
I think there should be hopefully no real surprises.
Yeah, there's nothing that I wasn't aware of, and all of the not achieved things that were flagged really well and truly flagged. So there's nothing in there that I thought was out of the ordinary. So I'm happy to move that staff recommendation. Stu will second. All those in favour, please say aye. Aye. As against, carried. So we now move on to the last item prior to lunch, which is going to be on page 229, and it's the Council Chief Executive and Director expenses to 30th of June. Yes, I know, he's coming to lunch too. 229.
Thank you, Mr. Chair. Happy to take this report as read. I trust that elected members will have received information around their own costs as they are reported, but happy to take any questions or feedback.
I'm just having a look at 229. Yeah, I had no comment or question. I thought they were all very well straightforward. There's no surprises to me. Any questions, comments? Yes, Andrew.
Well, it's a comment really, and I've said this for the last 2 years. I really admire our Chief Executive on page 233. That number for a full year is
Yes.
Well, I think it's actually woefully low, and I'm worried that he's not spending enough. He's a class act, and I expect him to. I'll put it this way: I chair much smaller rigs than this one, and chief executives burn more cash than that, and don't create the value that our chief executive's creating. So I'd like to send a signal to the chief executive that I appreciate that he's being modest, but I hope he's not being too religious in relating to his Scottish ancestry. I think there's merit in him being out and about, and that comes with costs.
Yeah, and I do note that he is attending meetings in Wellington, has some high-level ones coming up as well, where he's invited to engage with ministries at a very high level. So that engagement is being reflected on what council expectations were. So thank you for those comments. With that, you happy to move, Andrew? Happy to move, and I'll second. All those in favour, please say aye. Aye. Those against, carried. Now we're going to adjourn for lunch, and I see on my run sheet that Brian has a new surname, Brian Mercer.
Yes.
Yeah,
It got-
yeah,
it all
it
just
so
melds
happens.
into one.
So it all becomes one. But Brian, I'd like you to welcome you to join us for lunch, and we'll return for those online, mainly staff. Although we do have a couple of members who are going to come in late. We will come back at 1 p.m. and then we'll be straight into the Mercer reporting in public and various other things, and then we'll go into public excluded a little later. Thank you. With that, we're adjourned till 1 p.m. And welcome Brian from Mercer to present his report on the monitoring report. Oh, the last. Oh, you're going to move it? Yeah, it's his opportunity. He hasn't been here since we've been in a new building. Yes. Give us the salient points there, Brian.
Do I need to press this or you?
Yeah.
Make sure it's red.
There we are.
Move it around a little bit. Hugh, I can hear you.
Happy to second your motion.
So we're going to move her in a second. We've got Andrew McPherson and Hugh Burko has now joined us online. So, Brian, no, I'm going to let Brian say a few words.
I will be very brief, but thank you for that. Do we have the report up on
238
screen
page,
for people to see?
Page 238.
Sorry.
What was the report?
There's nothing in here that really spoke.
In the report itself or in the markets? No, it's certainly not spooked. The message today is about staying the course. I think very fortunately spent a good part of the last 2 years looking at strategy, the manager lineup, really kicking the tires on strategy, the conservative element of your strategy.
Sorry to interrupt. Are you asking me to put up a PowerPoint?
No, just the report.
Just the report.
Oh, okay.
Page 240, 241. 241.
I would have thought those conversations have set us up well for confronting the reality we've got here now. So
Yes.
in reading it, I didn't think there was too many surprises.
No, and I think the main thing to take into account is we have had 2 quarters of downturns, but market volatility doesn't die from old age. It has to run its course, and we haven't done that yet. We still have the driving forces of interest rates, inflation risks, and really how markets will react to that. That doesn't necessarily mean that more pain is to come. It just means that we can't assume a turning point at any time until we really see the light there. As an example, July has bounced back quite well, which we don't see in the quarterly report, but it is an interesting, it's always helpful to come into meetings and be able to actually point to things bouncing back. It has been a difficult 6 months of looking at markets. The portfolio itself has performed in line with the expectations versus the markets. So that's good to see. Stewart Investors, as the global equity active manager there, has struggled over a few years actually, so taking COVID into account as well. But looking at that strategy, they're still doing what we employ them to do. They're a value investor. They buy for the long term. They're sticking true to label. And again, the July numbers, which you can't see in this report, they've had an 8.8% return just in the month of July, which has outperformed the market by over 3%. So we know that they will deviate from the market from time to time, but still have conviction there. I think the key here is considering the strategy, which we spent quite a lot of time on in the last couple of years. And Janine and I did discuss in the run up to this meeting timing for the next review. We tend to do health checks every year or so just on the strategy. It would be advisable to probably wait out this period of volatility, let that feed through to the assumptions we use when we look forward at what bond markets can do, equity markets can do, and probably do another health check early next year. That would, and also with a councillor cycle, that probably fits in quite well to review the portfolio.
Thank you for that, Brian. The only, let's say, further comment you could make on page 250. If you go to page 250, there was a graph, and I've mentioned about this reserve position.
Yes.
So you can see that red line there dipping for the first time into below into the green. So just a comment on that. I note that, okay, this is looking back a bit and there might be a bit of an upturn. So you're thinking there about that reserve and the reserve position.
Yeah, absolutely, and that's probably the most relevant point from today. Is it's a relative position, and the important thing is to realise just how fortunate you were to have built up that reserve over the years. I know we've had a few discussions going, well, is that too big a reserve? And we've sort of tested the strategy and gone, well, actually, in a market cycle, you can expect times where a reserve of that size could be depleted. And of course, we're seeing that here. So in practical terms, it doesn't impact the portfolio. It's more of an accounting measure than a change to portfolio strategy. But ultimately there was enough kept away for a rainy day. We're now experiencing that rainy day. It is promising to see that July's popped up. My estimation would be that the portfolio has probably gone up about 3 million just over the month of July. We'll get those numbers shortly. So again, that helps to prop that reserve back up. And also important to remember that we don't include the low volatility fund in that. So back when it was all one fund, before you split out your low volatility portfolio, which is about 9 million now, I think.
In terms of that graph?
So the light green is the inflation adjustment.
Yeah.
So the dark green is the
base capital. The base
nominal,
capital, yeah.
and then the light green. So you essentially have the yellow was the true reserve, and the light green is your inflation protection.
And I think in terms of that inflation, I mean, the reserve dipping down into negative at the end of June, certainly the high inflationary environment has contributed to that as well in terms of the amount of fund return that we've had to set aside to inflation-proof the fund, let alone then meet that sort of took away a big chunk of money.
Yeah, it is. I just had one other question for others. When you see hedged global funds with its high level return, who wears that? In other words, who's the one who gets the loss effectively?
Are we comparing hedged to the unhedged?
Yeah.
Well, essentially, yeah. So that's the reason that you have both hedged and unhedged global equities is because it diversifies it.
Yeah, I understand.
So in terms of who, it's essentially you have a contract on with one of the banks.
Page 241.
251.
Oh, 251.
Yeah, sorry.
Yeah, so essentially, the hedge is simply a standalone contract to protect. So the bank would wear the other side of that.
That's right. Yeah. Thank you for that. Those were any questions. Any other questions, comments before we put the recommendation to receive this report? There being none, I'm happy to move the recommendation. Yes, it was moved. Oh, moved. Yeah, ahead of me. Oh, well, we'll put that. I was out of the room. All those in favour, please say aye. Sorry about that. Now we move on to Treasury Management Monitoring Report 257.
Thank you.
Thanks, Brian. Good to see you.
We'll see you. You've had a bit of a tour around, so yes. Enjoy the coffee. Feel free to stay on for a few minutes and have your coffee until we move into public excluded. Thank you. Janine.
Thank you, Mr. Chair. So this is really just a little bit more of the internal management processes underpinning the information that Brian's already presented. In terms of that reserving position, we've done it, presented a bit of a forecast of that at the last committee meeting, which was based on where the reserve was at the point in time and then what the LTP assumptions looked like. That's been updated in this report, so sections 21 and 22, with some updated projections, thanks to Brian, in terms of potentially what could we expect around fund return and inflation assumptions over that time as well. I think as has been noted, past performance is never an indicator of future performance. The reserve has done as it was there to do and provided a buffer for council through this period of high volatility, but just thought it was important to take a little bit of a closer look at that, given that it has dipped down into negative territory, and that if that position was maintained, then that may be cause to look at the strategy. As Brian said, he and I had a catch up about that. Yep. We will look at that in the new year with the new council.
Andrew moves and I'll second the Treasury Management Monitoring Report. All those in favour, please say aye. Aye. Are you ready to come back to the
Yes, I've got yes.
Right. We'll come back at this time to item number 10, which is the Tenders Board Contracts, 1 April, and that's on page, that's the one we left on the table, page 191. So we left that on the table pending some more further information from our CFO. So Janine will bring that one back onto the agenda.
Thank you, Mr. Chair. So there were two questions in relation to that report. One was in relation to the Ngā Waio Waikato Senior Catchment Officer contract. Just to confirm that what was being sought was an extension to the contract by 13 months and 22 days to make a cumulative contract term of 3 years. My apologies, not 18 months. So that total contract value of 384,000 reflects 3 years of work.
So sorry, Janine, by 384 by 310 real.
Correct. Just noting that in terms of that project, MB have provided funding of just under 247,000 per year for 3 years to engage at least 2 FTEs. So half of that funding is available to offset those costs, and the other FTE has been worked through in conjunction with Waikato Tainui around a capacity building position as well. So there is external funding to offset that contract value.
And there was a second point, wasn't there?
And so the other one was in relation to the project reboot contract extension. So just to clarify, the contract was initially approved in November 2018. This was after we had tried to employ somebody into that corporate systems lead role and had been unsuccessful with that. The extension to the contract takes us through to 31st of July 2023, and it has a contract day rate of $1,100 excluding GST, but that's all inclusive, so there's no further cost associated with expenses or mileage. That's all in.
Yep. So that's on page 191, the staff recommendation, and Stu, happy to second. Second by Stu Kneebone. All those in favour, please say aye. Aye. Those against, carried. So we now move back to item 16, which is on page 268, which is the Civic Financial Services Annual Report and Statement of Accounts to the year 31 March 2021.
So, Mr. Chair, this is just presented for information of the committee. Council has a very, very small, minor shareholding of 0.2% in Civic Financial Services. So this is provided for your information.
Thank you. Any questions? Hugh, did I hear you, Hugh?
I'm moving the report.
You are moving it. Okay. We'll turn up Hugh's sound a little bit so we can hear him. But Hugh's moving it, and yes, and Andrew's seconding it. Yes. Any discussion before we put that?
Civic Assurance is a great asset for the councils, and before they came into existence, we were being screwed by the underwriters, which is why Civic was formed to provide basic insurance cover for local authorities at a reasonable rate. Over time, it has a lot of it's gone back to the brokers, but if Civic was to disappear, we will start to be screwed again.
Yep. Yeah, it's certainly been valuable, I think. So,
and also a provider of a KiwiSaver product to the sector as well, which provides a low fees option for staff in the sector to participate in.
So we have a mover and a seconder. I put that. All those in favour, please say aye. Aye. Those against, carried. So we now move to the resolution to exclude the public, and I'd like William to just go over the reasons for that.
Screen. Let me just get up on the screen.
We have to transition up. Well, you have to give the reasons.
I understand that.
You don't have to. The problem is that there's a number of people who could be online or could view this later. So we have to give them. Well, what I do is on my meetings, I like to not read the whole thing out, just give the summary of the reasons why. So if you can briefly describe those reasons why we're going to public exclusion.
Yep.
Don't need to read the whole thing out.
Okay. To avoid prejudice to the maintenance of the law, including the prevention, investigation, and detection of offences, and the right to a fair trial. All this is under Section 6A of the Local Government Act, and also to protect information where the making available of the information will be likely and reasonably to prejudice the commercial position of the person who supplied or who is the subject of the information. Right. This is under Section 7(2)(b) of the Local Government Act. There's just one more reason. I'll just read out real quick. To protect the privacy of natural persons, including that of deceased natural persons, under Section 7(2)(a) of the Local Government Act.
Thank you, William.
2 minutes.
Right, we're now moving into public excluded, and I'll have a mover. I'll move. Yes,
No,
I know,
actually, no.
but I'm moving into, is in the public section, I'm moving in, and Stu's seconding, we move into public excluded. So put that, all those in favour, please say aye. Aye. Those against, carried. So we're now in public excluded. Right, so